Coinchange is a really simple value proposition. We do one thing and one thing only. We generate yield across the full DeFi ecosystem. Okay, and we do it on a risk managed basis, meaning that we don't allocate all liquidity into super risky pools with the super risky assets. And we don't allocate the full liquidity into very, very low risky pools with the very low risky assets. So we have a spread out allocation that's automatically managed to optimize the yield and ROI, right, based on the fees that are generated across those pools.
Joining us again is Maxim Galash. He's the CEO of Coinchange Financials Inc. at coinchange.io. Maxim, welcome back.
Thanks for having me.
Yeah, always a pleasure. Maxim, you seem like you're probably one of the best people in the world to talk to about all of the activity, we'll call it, in the crypto universe. And so the first question that comes to mind for me in all of this is, we saw what happened with Tether and Luna. We saw what happened with the Celsius exchange, and now we're hearing that Coinbase is having some trouble, and anybody who has deposits with Coinbase will be treated as an unsecured creditor, meaning they could lose everything. So my question for you is, to what extent do these risks impact Coinchange customers?
Yeah, thanks for high regard. Yeah, I don't think I'm the best person in the world, but we know something about the DeFi and the data on the DeFi, and it's showing itself pretty resilient compared to the centralized counterparties that you mentioned. So I don't think there's anything to worry about Coinbase. Right? So all that footnote print in the terms of service agreements, it's part of any standard package you'll find on multiple centralized exchanges. So I won't really be worried about that. But definitely the other aforementioned parties like Three Arrows, Celsius, Voyager, BlockFi, they're all fighting through the market right now, and we still will see how it all unwinds in the future. So Coinchange is a little different to compared to those counterparties. We don't really deal in centralized lending or replication world. That's the main reason behind the debacle, right? Sharp devalue of all the collateral and all the assets on the books of the counterparties, right? And the leverage in the system kind of self-cleaning itself right now, and there's a lot of margin calls and liquidation calls right now being made on each other. We don't really rely on centralized counterparties at all. The only centralized counterparty we have is you as a client. So we have retail customers and corporate customers who are supply side, right? Pretty much transferring their assets into our platform. And we have a demand side for that liquidity is a DeFi protocols, decentralized protocols that has been pretty resilient in the last couple of weeks, right? Apart from the Terra debacle that was a programmatic stablecoin. We're talking about the Uniswap, Aave, Compound, Curve, and the other transactional businesses, transactional applications on top of the blockchain, decentralized applications that are not influenced by a single party decision. So meaning that they function per certain programmed behavior with the open rules that are highlighted and described to the full extent on the white paper. So they are not incentivized to take any action because of the market sentiment. As an example, with the centralized counterparties, they are taking decision personally as a human being, and they will be pursuing their own profit in the first place. So somebody is shorting the Bitcoin and trying to do everything possible to let the value go down, to push the value go down. Somebody is long on the Bitcoin and trying to do everything possible to let the market stay where it is, right? So in that, if you're on the wrong side of the trade, you're getting liquidated. So for sure, we're not in that business. So we are not lending assets. We're not replicating assets. We're not taking any market positions and timing the market with our customers' assets. So it's a very different business. And I would say our customers are well protected and can find us to be a safe harbor because we never actually stopped the withdrawals. Since all this debacle happened months ago. And we did have some redemptions from the retail side. Obviously people are scared and they have no way to see through. But the corporates who understand our business and how we're different just open up their accounts.
There's been no change in the rate of interest, which is essentially at the base of your value proposition to your investors?
On the Ethereum side, I mean, if you look at the last 7 days, right, annualized return, we've been paying more than if you annualize it over last year. Okay, so because there's a lot of activity right now, transactional activity on the decentralized applications, right? Uniswap, PancakeSwap, Curve, Aave, a lot of transactions happening with the staked Ether, USDC, right, and USDT as well. So in terms of the stablecoin yield, yes, it substantially went down because liquidity has been drowned out, right? So DeFi liquidity is half, even less than half to what it was about 2 months ago. So obviously there is less liquidity, there is less activity, and there is less fees that are generated on those protocols, right, that we get a part of. So Ether is higher, stablecoins are lower, Bitcoin is trailing around 1% as it was always. So yes, we are affected, but it's at one degree we're affected in a good way, and stablecoins are lower than they used to be.
In the context and all that, and understanding that a lot of our viewers will not have seen the previous interview, can you sort of give us an outline of Coinchange's business and value proposition for its clients and how it differs from all of those issues you just described?
Yeah, so Coinchange is a really simple value proposition. We do one thing, and one thing only. We generate yield across the full DeFi ecosystem. Okay, and we do it on a risk managed basis, meaning that we don't allocate all liquidity into super risky pools with the super risky assets. And we don't allocate the full liquidity into very, very low risky pools with the very low risky assets. So we have a spread out allocation that's automatically managed to optimize the yield and ROI, right, based on the fees that are generated across those pools. It can be lending pools like Aave, it can be transactional trading pools like Uniswap, or it can be like serial pools like on Binance, so staking pools. Meaning staking, it's not a long-term staking, not a layer one staking. It's a protocol staking, and it's fully liquid staking. So not like Ether Lido staking that's has been a trauma for Celsius, right? So our business is allocating liquidity across multiple different pools, across the full DeFi ecosystem to generate yield on a risk-managed basis. Our customers don't see through to the assets. All they see is a very simple user interface that looks like your, I don't know, a simple neobank, with a few accounts, with a 24/7 support, customer support available, with the ability to buy and sell major assets like Bitcoin, Ether, and 3 stablecoins, and ability to move those assets into the earn account to start earning daily compounded yield with no lockup. So there's no minimum required, right? So you can put $5, you can put $5 million. There is no tiers on your yield, so you earn the same return on $5 or $5 million, and there is no lockup. You can request your funds at any point of time, right? And the only thing is that there is a certain cutoff time during the day. If you do it before the cutoff, you get it the same day. You get it after cutoff, you get it the next day, similar to a bank. But it's a fully liquid, and all the assets are always under our control. We don't lend the assets to third parties. We don't trade on those assets. We don't repoffecate those assets. So we don't have a centralized component to our business. We have a centralized component as an application that takes in a customer and does the full KYC and a compliance, right? That does account management, wallet management, and reporting. But the yield itself, the IP and the core of the business, is a fully decentralized basis. So there's no centralized counterparty. It's only those protocols, those applications that are built on top of different blockchains that govern a certain transactional activity. Either trading, so swaps, either lending, either insurance, either staking. So, and our smart yield, call it that way, orchestrates our liquidity across all those to maximize the yield and minimize the risk.
What are the risks to your clients and to your business? What are if those risks that are part of the other part of the ecosystem are not within your sort of bailiwick of concern, where are the risks? What are the risks in your business?
So the main risks are a protocol level risks, right? So when you provide liquidity to a pool, you exposed to a cyber attack or a hack of that pool of that protocol. So let's say if we hold our liquidity in Aave one of the pools, lending pools in Aave, and Aave gets hacked, there's a high probability that our pool that we feed liquidity to is going to get affected, and the liquidity is going to be exposed and stolen. So that's an exposure. The other exposure is depegging of a stable coin. So let's say if USDT depegs from its par value, right, it's a depegging risk. So we're losing value because we are considering it to be one-to-one as a stable. So there's also a market risk, but asset risk, not market, but market asset risk. But this is on the client. So if you hold the Bitcoin with us and Bitcoin goes down, you definitely get less dollar value for that Bitcoin out of the system because Bitcoin went down. So it's an asset risk, but it's a client asset risk. So there's three risks: client asset risk, protocol security risk, and depegging of a stablecoin risk.
It seems like a great business, except for if those risks you outline crop up. So if the risks, one of those risks was to materialize, and let's say that one of your pools was hacked and the asset's stolen, how would that affect your client? Are they insured? Are you insured? Is there any sort of guarantee, warranty, or are they exposed as an unsecured creditor?
So yeah, for sure there is no insurance. First of all, DeFi is still a pretty nascent market, right? And there is no concept of insurance. There is Nexus Mutual and a few other protocols that try to mimic the real world insurance, but it's not like a life insurance. You die and your family gets funding. No. So it's like a probability of insurance, of a principal to be protected. That's DeFi insurance. And we looked into that. We don't have that. We don't really buy DeFi insurance. So are they protected in terms of the warranties or guarantees? No. There's no warranties or guarantees of the full safety of the principal. Okay? So what happens if one of the risks are getting materialized? Then it's up to the management to decide either every customer is going to get notification that portion of their allocation has been lost, or the business is going to recapitalize that from their own balance sheet. So, and pretty much rebalance the loss on the client side. So that happened before to Bitfinex. I think they did pretty much a haircut to all their customers and announced that, right? When they lost it in a hack. Yeah. Because that can happen to a centralized exchange as well.
Sure.
Right? Coinbase, Bitfinex, you name it, right? It can happen to anyone. It can happen to a decentralized protocol.
Right.
So.
Okay, so then
it's a discretionary decision by the management how to handle the situation, but there is no insurance and there is no guarantee.
Right.
But it's a very low probability, and even if it happens, there's a low allocation, right? That's associated with every protocol because they're very distributed. We have about 25 protocols today, and we don't hold more than like 5% in any protocol, no matter the risk profile.
So risk management through diversification.
Exactly.
Bitcoin, for example, has now lost 70% of its value from its all-time high. What if it was to lose another 70% from here? How would that affect your business? Obviously, there's going to be clients suffering a devaluation in their portfolio because the asset has gone down. But if the asset keeps going down, is there an existential risk for the viability of your business?
We are market neutral, right? So all the liquidity provisioning we do and across all the pools is market neutral. So there's no impermanent loss. We don't take any market positions, right? So it doesn't affect our business. It affects our business indirectly through the market sentiment, as it does right now. So right now, as I mentioned, retail customers are scared, right? So they don't want to really feel a difference between us and BlockFi, us and Celsius, right? And you name it, right? So they're thinking these guys are paying EEL, they're all the same, no matter what the mechanics behind it is, right? No matter what the risk profile of that EEL is, right? So they're pulling out the assets, right? So we do have redemptions right now happening from retail, and we're honoring everything. You can look at our website. There is no hold on withdrawals, right? With corporate customers that do understand the difference and understand that right now DeFi showed resilience in the last 3 weeks, in the last months, right? There is a high transactional volume with a lot of assets, and there is a higher APY that we can generate. So they do top up their accounts as well. So it's all about the sentiment. If the Bitcoin market tanks another 70%, there's going to be more liquidations, there's going to be more blood, there's going to be more loss of capital, not only in the book, but in reality, right? So, and it's not going to add any confidence to anybody, neither to our corporate customers, not to the retail. So it's going to hurt the business indirectly, but it doesn't make us insolvent. We're not really dependent on the market direction.
Finally, what has changed in your business since our last interview back in February? Have you got more assets under management? Is there a bigger audience base? What all has improved?
Yeah, I mean, we're gradually improving, right, through different market cycles. And right now we have about 40,000, followers across all our social media. It's a strong community that we have. We have about close to $50 million of the assets on the platform, more or less. I don't remember when we spoke last, but trailing around the same number for the last couple of weeks. I mean, we had redemptions, but we have deposits. I would say that we also are taking a very interesting product to market. I mean, right now, as we talk, right, we have this one product that we take to market differently. So it's a daily compounded yield product, right, that we sell directly to retail customers, that they come and join our platform directly. We have a business customers, so that corporate joins our platform. Right now, we also have yield as a service, we call it. So it's yield API. So if you run your own app, let's say a wallet app, and you want to offer yield to your customers, then you don't want to just build that business from scratch, especially in the DeFi ecosystem, because it took us 3 years to build ours. You come to us and you integrate our API, right? So your customers on your app can transfer their assets into the earn account and start earning daily compounded yield. It doesn't cost you anything, zero. All it costs you is your development time to integrate, and it does create you a new revenue stream because it's a revenue share business for us. It does create increased retention for your customers, so they stick around longer with your business. It does increase conversion, so your customers convert more into your app because you have that extra feature. So we are taking it to market next month. We'll already have a couple of integrations done with one neobank from New York and one exchange. And we're going to start marketing it on our site and selling directly to our corporate customers next month. So I think this is a killer feature. This is a big, interesting way to go to market with the same product that we've been paying yield for the last year for our retail customers.
Awesome, Maxim. Well, that's a great update. We're going to leave it there for now. We'll come back to you soon. Thanks for your time again, as usual. See you soon.
Appreciate it. Thanks for having me.
You bet. Bye for now.